Well, for the time being, let's focus on Dixon Technologies. They posted an inline set of numbers. The revenue this quarter was up close to around 38%, led by the home appliance business. You had the other divisions as well, did do pretty well. The margins, though, they got hit by surging expenditure. The management has also lowered the guidance a little bit. Guidance now for FY23 is around 15,000 crores. EBITDA margins have been forecasted to come in at around 3.8 to 4% from around 4 to 4.1% earlier. Mr. Atul Lall, the MD of the company, joins in. Hi, Mr. Lall. First of all, happy Deepavali from all of us here at CNBC-TV18. But let's talk about your numbers. I'm looking at your largest part of your business. That's a consumer electronics business. Out there, you didn't get much growth, though volume surged up by more than 50%. That's telling us that the open sell prices, clearly the dip that we're seeing is hurting out there. So my question to you is, the volume guidance, you're already scaled down a little bit to around 3.6, 3.5, 3.6 million tons. Is there a downside risk? And keeping in mind that realizations are getting hit, what do you end this year with in this vertical? That's a consumer electronics business. Last year, you did around 5,100 crores. Go ahead.
Wishing you a very happy Diwali and a very happy Dhanteras. So if you see our consumer electronics business, the LED television business, the volumes have grown from somewhere around 7.5 lakhs to around 11.5 lakhs, which is a volume growth of 54%. But the unit value of a television from the second quarter last fiscal, it was 18,000 rupees. It came down to around 11,000 rupees in the quarter under consideration, primarily because the open sell prices, which contributes almost 65% to the bill of material, it just crashed. Now, it doesn't make a difference to us because for us, it's a pass-through. However, on the revenue side, it had an impact. So what should have been a 54% growth in revenue turned out to be only 3% growth. But the margin expansion of 50 bips took place. So we have done very well in the second quarter. Order book looks good. I maintain that we are going to be doing approximately 3.6 to 3.7 billion in the current fiscal. That's the way it's going to be. However, the revenue growth is going to be somewhere in the range of around 7 to 10%, because I again see the open sale prices in last 2 weeks creeping up. So that's the way it's going to be.
So Mr. Lall, the problem, of course, also lies in what's happening with the operational performance, right? You've scaled down your margin guidance. Is there a threat to that guidance as well? I mean, could it get much worse before it gets better?
So the margin guidance that we had given was around 4 to 4.5%. I maintain the margin guidance would be somewhere around 4%, because there has been a slight downside because the dollar appreciation. However, the commodity prices and also the logistics cost has significantly come down. So there is, to a large extent, balancing. So what I feel is that we should be able to maintain in the range of around 4% with 15,000 crores of revenue.
Okay. All right, 4% margins, 15,000 crores revenue maintained. Mr. Lall, thank you for joining us. Could you talk to us a little bit about the mobile phone PLI revenues in terms of booking, how that is going to look like for the rest of the year? And you're doing so much, right, in terms of diversification, the newer products, laptops, tablets. Just tell us which is the most exciting opportunity, large opportunity, which you will start working on, in the next 2 quarters.
So on the mobile PLI side, we are the first Indian company, in fact, first company amongst Indian and global companies across all the sectors in which PLI has been rolled out, which has got the PLI approval and also the disbursement. I think that's an extremely positive development. We are going to be hitting the upward ceiling that the government has prescribed for us in the current fiscal. In fact, we're going to be much beyond that. We are in the final stages of concluding a couple of large contracts in the mobile space. We've already started manufacturing 5G. So mobile is going to be one of the largest triggers in a growth journey in next 2 to 3 years. Apart from that, you're absolutely right. We are pursuing various diversifications. So we have started manufacturing hearables and wearables for our JV partner Port, for which a new factory is being set up and is going to be operational by December of the current fiscal. We have already ramped up our production of TWS from our 100K a month to almost 1 million devices a month. That's a number we touched in September. And this is on a high growth curve. And very shortly, we'll be starting manufacturing of neck bands and also smartwatches. And the other diversification that we pursued was in the space of telecom devices, mainly the ONTs and modems for Airtel. So that production has also reached almost 100K devices a month. So, and similarly in IT space, we have bagged a lot of almost 500,000 units for tablets from a very large global brand. Yeah, so it's an exciting journey for us.